Hey traders, it is Matt Stevenson with Paragon Funded Trader and Paragon Elite Trading. I just want to talk a little bit about stop losses today and where we should be putting them and what we should be aware of. Now we've all been told throughout our trading careers, always use a stop loss, right? And that's not wrong, but here's what nobody tells you. Where you place it is exactly what's getting most of us killed. Because today's market isn't random. It's engineered around liquidity. And your stop loss, that's liquidity. Most retail traders place stop losses in the same places: below obvious swing lows, above clean resistance, right outside quote structure, right? It feels logical, safe, disciplined. But to an institutional algorithm, that's not protection, that's a target. Because large players don't enter trades the way you and I do. They need liquidity to fill size. And the fastest way to get it, trigger a cascade of stop losses. What you're seeing here is a classic pattern. Price pushes into a level, wicks through it aggressively, triggers stops, and then immediately reverses. How many times have we seen that? That move isn't failure, it's fuel collection. Your stop becomes the counterparty to their entry. And this is where most traders get trapped. They think, I was right, but my stop was too tight. That, to me, is the worst trade possible. When a wick swings up, stops me out, and then the trade goes the way I thought it was going to go, and I'm not participating. I hate that trade. So, what do traders do? They widen the stop or move it further below structure, which just makes them an even bigger target because the issue isn't distance, it's predictability. Risk is not where your stop sits on a chart. Risk is your exposure relative to uncertainty. If your stop is sitting exactly where everyone else's is, you're not managing risk. You're participating in a liquidity pool. Professional traders don't ask, where should my stop go? They ask, where would I attack stops if I needed liquidity? And then they build positions around that answer. So what changes? First, stop anchoring your risk to obvious structure. Structure is visible. Visible means crowded. Crowded means vulnerable. Second, think in terms of zones, not lines. Liquidity doesn't sit at a single price. It clusters, right? If anybody's seen a volume profile in a chart, you'll notice that. And third, accept that precision entries come after displacement, not before. Let the sweep happen. Let the stops get cleared. Then engage when the market reveals intent, especially in metals like gold and silver, where volatility is often engineered specifically to clear retail positioning before continuation. The market isn't out to get you, but it is built to use you if you're predictable. So the goal isn't just to use a stop loss, it's to stop thinking like liquidity. Because the moment you shift from defending levels to understanding why those levels are attacked, you stop being the target and start thinking like the participant on the other side of the trade.